Imagine you're driving down a highway. Some exits are packed with cars, barely moving, too many people trying to leave at once. Others are wide open, letting traffic flow freely. Crypto prices move the same way. These invisible traffic zones are called supply and demand zones, and if you know where to spot them, you can understand why prices move the way they do. Think of supply and demand zones like popular gas stations on a long road trip. Supply zones are like crowded stations where everyone is trying to sell gas at the same time. Too much supply, and prices don't go higher. Demand zones are like an isolated station in the middle of nowhere. Everyone needs gas, and prices shoot up. Traders use these zones to predict when prices will reverse, just like drivers planning when to refuel or take an exit. Step 1. Spot the traffic jams. Look for areas where price keeps getting stuck, either struggling to go higher, supply, or bouncing back up, demand. The more times a price level has caused a reversal, the stronger it becomes. But if price hits the same zone too many times, it weakens, like a traffic light that eventually breaks down from overuse. Step 2. Mark your roadmap. Draw horizontal lines at these key levels on your chart, but don't treat them as thin lines. Prices fluctuate, so it's better to think of them as zones, like a stretch of highway rather than a single lane. Higher time frame zones, like daily or weekly charts, are stronger, just like a major highway holds more traffic than a small side street. Step 3. Check for heavy traffic volume. Tells you how many cars are on the road. If trading volume surges at a demand zone, buyers are stepping in. If volume spikes at a supply zone, sellers are in control. But watch out for fake detours. Sometimes price temporarily breaks above or below a zone before reversing. This is called a fake out or liquidity grab, like a GPS leading you down the wrong road before redirecting you back. Do you rely on supply and demand zones, or do you prefer using technical indicators? Drop your thoughts in the comments. Step 4. Follow institutional traders. Institutional traders often react to these zones before retail traders, making them key areas to watch. Supply and demand zones work best when combined with trend analysis. Buying at a demand zone in an uptrend is usually safer than trying to buy in a strong downtrend. Have you ever bought crypto right before a major reversal? Let us know your experience below. If you love learning about crypto and market trends, then remember this post is brought to you by the Crypto Chrome. Like, follow, share, and repost this video if you believe that crypto is the future, and the future is now.